Okay, everybody, it's been a wild 36 hours here. We're going to get into Silicon Valley Bank imploding. The FDIC has shut down Silicon Valley Bank, and there's many different things we have to discuss. With me today, as always, the dictator himself, Chamath Palihapitiya, the Rain Man, David Sachs, and the Prince of Panic Attacks No More, his wire's cleared, David Freeberg, the Sultan of Science. Welcome, boys. How is everybody, just to start this off, contextually, the last 24 hours, can you recall a time in our careers where it's felt this acute or insane or intense?
2008 and COVID.
Okay.
And I think that this is right up there. Could be 2, probably 3 in terms of the level of panic and concern. The problem is we're in the middle of it. We don't know what's going to happen this weekend. So there's a lot of anxiety right now, a lot of panic going on. And a lot of, unlike COVID and '08, really acute effects that many companies and investors are actively dealing with right now, not just a few, thousands of companies that are really in a state of distress right now. So it is potentially, from a Silicon Valley perspective, worse than '08 or COVID.
Oh, for sure. For sure. I mean, this is basically a Lehman-sized event for Silicon Valley. Remember when Lehman Brothers went out of, basically filed for bankruptcy in 2008, started the whole financial crisis. The federal authorities thought that the best plan for Lehman was to file for bankruptcy. They didn't try to save it. And that basically led to a cascade where the whole financial system almost collapsed. I think that SVB, this is a Lehman-sized event for Silicon Valley. And there's 2 big things happening. One is the impact on the startup ecosystem. So you're seeing probably thousands of companies now cannot make payroll in the next few weeks because their money is trapped and tied up at Silicon Valley Bank, which is now under receivership. So if you wired your money out yesterday, you're good. And a lot of people managed to do that. But there are a lot of people who had wires in the hopper, didn't make it. Today, logged into the website, can't log in. Their money's just frozen. And we don't know when they're going to be able to get their money out or how many cents on the dollar they're going to get. So basically, the whole startup ecosystem is in peril. I think Gary Tan called it an
extinction level event.
Yes, exactly. That was a good term. And just to be really clear, this is not big tech at risk. I know there's a lot of people out there who don't like the idea of bailing out big tech.
This is not Google. It's not Amazon.
Exactly. Those companies have plenty of cash. They're fine. This is small companies with 10 to 100 employees. And you're looking at maybe thousands of them just being wiped out for no reason. They didn't do anything wrong because of this. This could have a very damaging effect on the startup economy and the whole United States economy. This is little tech. These are the future companies that will keep the United States competitive versus China and the rest of the world. And then the other big thing that's happening, and this is all happening in real time, is a regional banking crisis. Because when depositors see that their money was not safe at SVB, which was a top 20 bank that, as far as everyone knows, was in regulatory compliance. Nobody has said that SVB wasn't compliant. As far as we know, they had a regulator's seal of approval. And now you find out your money was not safe and it's not FDIC insured above $250,000. So the conversations we're all seeing in our chat groups with leading investors is, why the hell would you keep your money anywhere but JP Morgan or a top 4 bank? And so I think that unless the Fed steps in here over the weekend, we're going to see potentially a run on the regional banking system, a cascade like we saw in 2008.
Well, Sachs, let's just take a step back because I think that you're right, but we should talk about why that happens, the contagion drivers.
And just so people know, Silicon Valley Bank is used by 50% of venture-backed startups. And I would say the majority of venture firms also have their money there. So this morning, I got a note from a fund I'm an LP in. They had millions of dollars that they can't access to invest in startups. So Chamath, there are many products and services that Silicon Valley provides. One is, banking services to startups. Another is to venture capitalists. They do the mortgages for venture capitalists and for founders as well. They provide those kind of white glove services. But you also mentioned in our group chat, they also provide loans to GPs, general partners, to people who run venture firms. So the impact could also hit there. Maybe you could explain what that is. And then we'll get into what happened here. Yeah.
Well, I think it's important maybe actually just for Friedberg to just explain what's happening. But
Okay.
maybe let me just do the lead in and then Friedberg can do the details. But for those that are far away and aren't even sure what's going on, the basic problem that we have right now is in the last 36 hours, a key part of the financial plumbing of Silicon Valley has basically been turned off. And as a result, billions of dollars of deposits have basically been frozen. It means that people can't pay their bills. It means that people can't access their deposits. It means that credit lines could be in default. It means that payroll can't be met. And so as a result, we have this potential contagion on our hands. But in order to understand it and unpack it, I think it's important to explain exactly how this came to pass. So let me just hand the ball to Friedberg and then we can talk about some of the implications, of which there are many.
Yeah. Before Friedberg starts with the why, just the what that's happened as well. This all started on Wednesday evening when Silicon Valley Bank's CEO published a letter to shareholders announcing that the bank was rebalancing its balance sheet by selling tens of billions of dollars worth of mostly U.S. treasuries. And then they announced they would raise some money and sell some shares in Silicon Valley Bank. Then the shares in Silicon Valley Bank as a publicly traded entity dropped 60% on Thursday, then another 60% on Friday. Of course, then the entire world got focused on this, and then every venture capitalist started telling, or I would say the overwhelming majority of venture capitalists told their founders to get their money out of SVB. Then you had a classic run on the bank. A small number of venture capitalists gave advice to say, hey, we should support Silicon Valley Bank. I understand that, but it turned out to be really bad advice. And then trading was halted on Friday morning pending news. And then finally, the FDIC shut down Silicon Valley Bank at noon on Friday. And there's a lot of speculation of what will happen on over the weekend. But maybe you could walk us through technically what happened to Silicon Valley Bank and why they had this cash shortfall. And this run, we explained the run on the bank basically, but what led up to this?
The irony is it really was and is, prior to the quote run, a financially solvent business. So I have a few slides. If you're on YouTube, you can see it, that we pulled one slide that was kind of made by us and the other set that come from Silicon Valley Bank's actual presentations. But if you look at their balance sheet, this is from the end of the year 2022, you can kind of look at the stuff that they owe, their liabilities, which is what they owe their customers that sits in deposits. Because when customers give you cash in a deposit, you owe them that money back. So that sits as a liability. And then they had some other debt. So in total, Silicon Valley Bank at the end of the year had about $195 billion in liabilities, $173 billion of customer deposits that they owe to customers and $22 billion of other debt. And then they take those customer deposits and they invest it in a number of securities. And the way that a balance sheet business like this bank would operate is, the customers have access to their cash anytime they want. But in order for the bank to make money, they make longer duration investments. And those longer duration investments give them the ability to earn money on those longer duration investments more than they're paying the customers for the deposit. So if you look at their longer duration investments, they had about $208 billion of total assets sitting on the balance sheet. So compare that to the $195 billion that they owe customers and other debt holders. So, the difference here between 208 and 195 is about $13 billion. That's kind of the net, what people would call book value of Silicon Valley Bank at the end of the year. And of the 208 billion of assets that they had, 74 billion were loans, and they've got a breakdown of the loan portfolio here in a minute. 91 billion were these hold to maturity securities, where they don't actually adjust the value of these on a quarterly basis. And 26 billion is what triggered this panic, which is available for sale securities, mostly treasuries. And what happened is Silicon Valley Bank's deposits came in so quickly over the last couple of years that they went out and they bought a bunch of treasuries, with the cash that they got. And the problem is that very quickly...
Friedberg, it's actually MBS. They bought a bunch of MBS, 10-year duration MBS.
And important to note, of the 208 billion that they have the book value, Friedberg, there was a 10% of it's in cash or something. So they do have some cash there.
That's right. Yeah, sorry, it's a good point. If you go back, so let's say that of the 173 billion of customer deposits, they've got 14 billion of cash, and then they've got all these treasury securities they can sell, call it 40 billion. So if 25% of customers said tomorrow, hey, we want our cash back, theoretically, they could just dump those treasury securities, distribute the cash, and give it all back to customers. The problem is if suddenly more than 25% want to get their cash back, well, now they have a problem. And is effectively what triggers the run on the bank. As soon as some folks think that others might be pulling money out, then everyone rushes to be the first money out the door. And that's what triggers a classic run on the bank. There's a statistic, I think, in the 1920s, there were several hundred banks that had runs every year for almost the entire decade. And this was like a regular kind of occurrence that happened in the 1920s that ushered in a lot of our modern securities laws that are meant to kind of create the necessary liquidity provisions in how these banks are able to operate to make cash available to customers. But what happened is...
So much so, by the way, Freeberg, that they made a movie, It's a Wonderful Life, about a bank run.
So basically, one of the bigger problems that Silicon Valley Bank, they ran into two big problems. Number one is deposit decline, where VCs were not investing new money. And when they were not investing new money and startups were burning more money than Silicon Valley had modeled they would be burning, because they thought everyone was going to reduce spend and reduce burn, and they didn't. So deposits were going down while all these startups were burning money. No VCs were investing. So total deposits were on the decline. Meanwhile, their bond portfolio, the assets that they hold on the balance sheet, also declined in value. And I kind of just put a really simple illustration here on why. If you have a $100 kind of face value bond that earns 2%, which is basically, where these treasuries were a year ago, and you hold that for 10 years, that 10-year bond yields $122. If the interest rate goes up to 5%, then that bond should yield $163. So the value of the first bond actually goes down by 25% because of the market conditions. That's how significant the value changes with just a 3% change in the interest rates. And that's effectively what happened with that available for security segment of the Silicon Valley Bank portfolio balance sheet. They had this bond portfolio that suddenly got devalued, and they had declining deposits. So when deposits start to decline, you got to make sure you have enough assets sitting on the balance sheet. So they sold a bunch of them, said we're going to raise more money. And at that point, everyone kind of perked their head up and said, oh my gosh. What's crazy is in Q4, by the way, Seeking Alpha, this website you guys know, they had actually done an analysis and said, is SVB about to blow up? And they put together a bunch of slides that highlighted why this might be the case, because they saw that deposits were declining, that their assets that they hold were basically declining in value because of the massive and very quick rise in interest rates, and that SVB had bought a bunch of bonds that were long durated bonds. So it led to obviously a real short-term problem. If you look at the rest of SVB's loan portfolio, there's also a question of how distressed that all is. So 10% of their $70 billion plus of loans is in venture debt. And venture debt is very questionable in this market, right? Because historically, the way venture debt makes money is that they assume that VCs are going to keep funding the companies that they're providing debt to. And if the VCs stop funding the companies, then the venture debt defaults. And so if you go to the last slide in this deck, you'll kind of see SVB's performance on their venture debt portfolio. Yeah, so look at this. This is the performance results on just the warrants that they get on their venture debt. So when you issue venture debt, you take a write down or you get paid back. And then you also get some warrants. You get a right to buy shares in the winners, in the startups that work. And so the way that SVB's made money on their venture debt portfolio historically is hopefully they get paid back on all their loans. Some of them they don't. But then they'll make a bunch of money on selling their warrants or the companies going public or getting bought. And in Q4 of 2022, it just fell off a cliff. And their venture debt portfolio really started to show distress. And that's 10%.
Are these realized gains or these are mark-to-market gains?
This is the net gains on their warrants. So they don't mark-to-market warrants. I think this is what they actually exercised and got out. So there was obviously a ton of exits in 2021. So they made $560 million in profit on their warrants that they had in their venture debt portfolio in 2021. That number collapsed to 148 in 2022. And you better believe most of that was in the early part of 2022. So, they didn't do a quarterly breakdown on this. This was like their full year numbers. But their venture debt portfolio, which is another $7 billion of capital, also distressed. Certainly wasn't going to perform as everyone had modeled. So when you kind of start to add this all up, and remember, if you go back to the beginning, they only had $15 billion of true net book value, which is the difference between their assets and their liabilities. And so if you really start to adjust, what are those assets really worth? Are they really worth what they're holding them at the book at? And if people start to pull money out and you got to sell them at a distressed price in order to give people their cash that they're owed on deposits, that's when you have a classic run on the bank problem. And then everyone tries to be the first out the door. And that's basically like what triggered this week.
Can I give you guys my little version of all of this? I think there are 3 buckets, but before I go into the 3 buckets, I just want to say to all of the employees at these companies, I think we, the four of us, are so truly sorry for what's going on and what you guys are going through. And then to founders that are trying to navigate this, it must be unbelievably tough. There are a few founders in our portfolio. So, from all of us, just know that we're thinking of you guys, and hopefully everybody ends up on the other side of this by Monday or Tuesday with not a lot of damage. So let's just put that out there as sort of like goodwill and kind of good juju in the world for the next
This is going to be a really
here.
difficult weekend for people who are trying to navigate this.
Yeah.
I think it's well said. Yeah. I mean,
and who didn't
I've
get
got
paid,
founders
et cetera,
who
et cetera.
are in really, really tough shape right now trying to figure out how do I make payroll? And it's a big question.
Okay, so just putting a pin in that because we'll come back to it. I think that this whole debacle, I guess, is maybe the best word. There's a little bit of blame that you can put at the feet of three different groups of actors. And I just want to get your guys' reaction to this. So group number one, and Friedberg just mentioned this, is we, the four of us, have been talking for the last 18 months about the impact of rising rates. And, we talked a lot about, for example, like in our portfolio, my partners and I walked into every company and made them have at least enough money to get through mid-2025, right? I've said this a bunch of times. And so that was about having very difficult conversations about making sure that you were husbanding cash so that you had enough to weather any storm that came on the horizon. But it turns out that there was some group of VCs and companies that just didn't get that memo and just kept spending like nothing had changed. But when other VCs have stopped giving you money and you're continuing to spend like it was 2020, that's what caused this mismatch. And it was really the spark that lit the fuse. So I think it's a really sad commentary at some level about the lack of governance that we have inside of some of these companies, where folks are just not doing the job that they're supposed to at these board levels. I think people, and we've talked about this, have made venture too much of a popularity contest where they are, glad-handing and smiling and not doing the hard work of holding folks accountable. And so some handful of VCs and some handful of founders just didn't get this memo, and it made what could have been a slower train wreck faster unnecessarily. So I think that's worth talking about. Then I think if you look at what actually practically happened over the last year and a half at SVB was that they were so desirous of profits that they basically had a duration mismatch. So what is that? Imagine you get a job and, somebody's like, hey, Friedberg, I'll pay you $100,000 monthly over some number of months, right? In normal pay every 2 weeks, or I'll pay you $200,000, but you only get paid once a year. Well, the problem with that second thing is you still have monthly bills that you have to make up for before you get paid. And so most people wouldn't take that job even if they paid you a lot more because you have this durational mismatch. You have to pay rent every month. You have to pay bills on a monthly basis. You have credit card bills, all these things. And so you need to match the timing of your cash flows. And so I think somewhere along the way, the risk folks at SVB just made a really large miscalculation. They basically went and bought 10-year risk in order to pay back money that could be called on a daily or weekly basis. That, obviously in hindsight, was not a good idea.
But more importantly, Chamath, they didn't adjust fast enough.
Well, they can't because they have these mark-to-market assets that were just getting clobbered in the head as rates got raised. And then the third thing is around regulators. After the great financial crisis, we went through a period where there was hundreds of bank failures. And then for the last decade, there've been virtually none, right? They've been like a few here or there. And the last one was just during COVID. And so the regulators, I think, have done a really good job with Dodd-Frank and all of these other things to clean up the banking laws and the reporting requirements and the capital structures so that runs on banks are more and more infrequent. But they kept this crazy loophole around the accounting treatment of assets, and they allow these durational mismatches to appear in a bank's balance sheet. And so I think there's a piece here for the regulators, which is, here's an opportunity that's glaring and obvious now and screaming about how we need to tighten some more of the transparency that's required. It shouldn't be a group of armchair sleuths on Seeking Alpha that sniffed this out 3 months before it happened. It should have actually been a regulator that said, hey, hold on a second, something is happening here that we don't like. And so we, I think, need to figure it out. But I think those are the three actors that are in play, and they each share a bit of the blame here.
Friedberg, Sachs, what do you think? Who is to blame here most for this blow up? Or is this just the exogenous event of the rate hikes happening in such a short, compressed period of time?
No, I mean, look, I think that SVB's risk management was terrible, obviously. They signed up for these long-dated securities when the market they serve is incredibly volatile. Like Jamal says, duration mismatch. Really good point. I would also say that there's a weird regulatory treatment where apparently if you buy these 10-year bonds, these 10-year mortgage-backed securities or 10-year treasuries, you don't have to recognize the loss until you sell them, which is just bizarre. So in other words, they should have been marking the positions to market. And instead, they just were allowing these losses to accrue. I don't understand how the regulators can allow that kind of system. I also don't understand how the regulators can allow a bank to take customer deposits and loan them out to startups with this venture debt that we've been talking about on the show, where 10% of their portfolio is basically being loaned out to startups who have no credit. That's crazy. We talked on the show a few months ago.
It's a good time to play the clip here because what we saw, and Sachs and I, seeing at the Series A level, you have a lot of times founders would get this basically free money in their minds. I raise 10, I get 5 in venture debt, I can extend my runway, but that money comes due. And here's the clip for when Sachs and I were talking about it just a couple episodes ago.
What I don't trust is whether the return models on venture debt that were created over the last 5 to 10 years will be a good predictor of what the returns will be in the next 5, 10 years when a lot of the mortality that should have happened in the past now happens in the future.
Yeah, I mean, this is just 4 or 5 episodes ago. We kind of nailed it.
Startups have no collateral. There's no security for that loan. How does that make sense?
No,
to make
not
a
true.
Loan to a creditless startup.
Not true.
Guys, look, I disagree with you on this point. Look, if you pull up the slide that breaks down, so let's talk about venture debt for a second, because I've actually invested in a venture debt fund and I've seen the economics on it. The way that the venture debt model typically works is the lender loans money to the startup, and what they underwrite is what the current VCs in the startup say they're going to do to support the company in the future. So their ability to get paid back in the future is largely predicated not on underwriting the company and the performance of the business or the assets they have, but it's underwritten by the fact that the VCs are committed to continuing to put money in and hopefully see that this thing has a big outcome.
There is no commitment. There is no commitment.
Yeah,
I've signed hundreds.
I get it, but
no, let me tell you.
Hold on, let me just finish. Hold on, let me just finish. I get it, but the asset as an asset class, we can make fun of it all we want. It's actually performed pretty well. These guys have generated typically 18% as an industry kind of returns.
In a bull market.
And yeah,
in a bull market.
You're right. It's the same as venture.
Lifts all boats.
And the way that they generate those returns is that they're loaning money to the startups. A bunch of those startups fail. They don't get paid back. And then the ones that succeed, they actually take warrants in the startups. So they have some equity upside in the startup. And that's the way the model works. We can make fun of it all we want. It actually works as an industry.
Okay, so let me tell you why that broke is it goes back to the point you made earlier in the show, which is the lender has this expectation that the VCs are going to keep investing. Well, what if they don't? Now, we've been in a generally up and to the right bull market since the last crash in 2009.
14
so I
years,
believe that the
years,
data for all these models is skewed because it assumes, again, an environment in which companies keep raising up rounds. As soon as you get into a crisis in which that breaks, then the whole asset class breaks. I think this was completely predictable. But even if you think that this asset class is legitimate, I don't understand why banking deposits could ever be used to fund it. If you want to be a venture debt fund, go out and raise money from LPs. Because what happens is when you raise it with customer deposits, you're creating systemic risk for the banking system.
100%.
And the regulator should never have allowed that.
Even worse,
100%.
The two assets are correlated because you're loaning it to people who are depositing it.
And in every other part of the private credit market that is exactly what you do, what Sachs said. You can't use customer deposits to do some CLO deal or to do to back a PE play. These are all LP capital that goes towards that. This is the only sliver, as far as I know, where you take customer deposits to create very risky loans wrapped with warrant coverage. And by the way, this stuff is never free, right? So they make you keep your money there. They make you have enough money to cover the size of the loan in the first place. So it's not even that valuable, because if they gave you $8 million loan, you have to have $8 million always on deposit. Otherwise you violate you breach the loan. So there is no free lunch in venture debt. There has never been. And I still think venture debt is very much like venture capital, which is most of these gains are on paper. Most of these gains haven't really been realized. And now we're going to go through this sorting process when all of this stuff gets whacked. I do want, Saxy, your reaction to this, though, which is the thing that started this was the fact that VCs, seeing the markets imploding, stopped giving companies money, but they didn't do enough work to help founders cut burn. SBV said it themselves. The burn stayed the same. What is going on inside of these boards?
Well, I think that's crazy because, listen, I mean, we started doing portfolio updates with our entire portfolio of founders in February last year, saying this is a regime change. You got to cut costs. We did another one in May. You can watch them both on YouTube, okay? And we were telling founders, cut your burn, do it now, don't wait. We were beating the drum on this so hard, and in every board meeting and privately, and and it takes multiple times, frankly, to get through.
I think your point, Chamath, about not wanting to be unpopular with the founder crowd led some young capital allocators to maybe say, okay, yeah, let's try this ditch effort before we do, another riff. Let's try this new product. Let's change our sales strategy.
I don't think it's young versus old.
I think it's experienced versus unexperienced. No, I think it's experience.
Okay, that's better. I think that's more accurate.
I think there's experience. Listen, if you've never lived through a bear market, you don't know how bad it can get. And tech is a boom bust cycle, and the busts are really hard.
Really hard.
Really hard. And if you've never lived through a regime change before, like there was in 2008-9 or in 2000 was the worst.
2001 to 3.
Then you're totally unprepared and you have no idea. And, and I think experience does matter. And there aren't that many VCs around who lived through the dot-com crash.
No, probably 85% have not. By the way, if you guys pull up just that slide on the loan portfolio at SVB, I just want to make the case. Sachs, I hear you. It seems like a risky investment to make. But don't you guys agree that a balance sheet business like SVB or an insurance company or any business that has some amount of money coming in that sits on the balance sheet and then they invested for a period of time, there's a laddering of risk and there's a laddering of duration that you have. And so if you look at Silicon Valley Bank from the update they did last week that triggered all of this, if you look at SVB's loan portfolio, 70% are really these asset-backed loans, which are 56% of the portfolio is prepayments on LP commitments, and then 14% is private banking loans, which is loans against public securities that people have. Only 10% of the portfolio is venture debt, which is $7 billion. And look, if the asset historically has performed at an 18% kind of rate of return, what is your venture debt portfolio going to look like in a distressed environment? Is it negative 100%? Is it negative 50%, negative 40%, negative 30%? I mean, you guys can have a point of view on this, but look, I mean, for any business that's managing a large balance sheet of assets against, a short kind of liability tree, they're going to have some riskier assets. I think, the question is, was 10% too much of the loan portfolio?
I think 1% is too much.
Yeah, and I'll add to that. One of the issues here that we saw qualitatively, and Sachs and I both saw qualitatively, is the standard for giving these and the size of them got lower and lower. In fact, the covenants went away. And this is what we kept having founders say to us. It has no covenants. They offer me no covenants. I don't have to have a certain amount of cash. I don't have to have a certain amount of revenue. Those covenants were there for a reason, to filter out the people who can't afford the house, right? And this is exactly what happened in 2008 when people started giving those no recourse or no background check mortgages. Remember those where you didn't have to do a background check to get a mortgage? That's what happened in venture. They just gave these. I saw it firsthand, willy-nilly. I begged founders to not take them. And I only won that discussion, Sachs, 1 out of 5 times, because founders are like money.
We're having this debate, but there's no indication, and there were no losses in this portfolio to date that show that venture debt's underperforming. We're saying that this is stupid.
What's
and
the
no one should do it.
expression? Past performance is no guarantee of future performance.
Exactly.
It's obvious to us on this podcast.
You guys are arguing about venture debt when the real loss that happened at SVB
we
was the
understand
fact that they bought a bunch of treasuries and interest rates went from 2% to 5%.
Let me
hold on. There's 2 things going on here. Okay, Friedberg. When I see your chart and you talk about laddering this and laddering that and X% and all this kind of stuff, I think about the smartest guys in the room. Okay, this is long-term capital management. This is Enron. This is the 2008 bank failure. They think they can basically do financial engineering to make this work. You know why it doesn't work? It's because number 1, they're not in fully liquid assets. Number 2, they're not marking to market every day. If you're a deposit bank, you should be required to keep all of your assets in fully liquid securities that you mark to market every day. It's that simple. And what do? They put it in 10-year duration mortgage
we
bonds.
need to explain this.
Where the value got devastated with the rise in interest rates. They didn't have to mark that to market. And second, they put 10% of the portfolio in basically loans to creditless startups. So when there is a run on the bank, you have roughly 30% gap between deposits and the value of their portfolio.
Yeah. And listen,
that shouldn't be allowed. And the reason it's allowed is, frankly, I think regulators are completely asleep at the wheel. Where's Powell? Where's Yellen? 2 days ago, Powell was testifying in front of the banking committee, and they asked him, do you see any systemic risk in the banking system because of the rapid rise in interest rates? He said no.